There are few certainties in life, and one of them is that you will pay taxes. In today's video, I will explain to those of you who have just started your investing journey how taxes impact your investments and what strategies can help reduce your tax burden. We will explore different types of investment accounts and explain why choosing the right one can significantly affect your tax savings. Additionally, I will break down how earnings from the stock market, dividends, and interest are taxed. In the world of investing, your accounts can generally be classified into two types: taxable accounts and tax advantage accounts. Let's start by understanding what each means and how they impact your tax bill. Taxable accounts are what many of us think when we consider investing. This includes your standard brokerage accounts where you might hold stocks, bonds, or mutual funds. The key thing to remember with this type of account is that any profit you make from selling investments, like when a stock you own goes up in price, is taxed in the same year you make the profit. This applies whether you're earning dividends from stocks or interest from bonds. Now, tax advantage accounts offer benefits that can help you save on taxes. These accounts are designed to encourage savings for specific goals such as retirement or education. There are two main types within this category: accounts with deferred taxes and accounts with tax-free growth. Deferred tax accounts allow you to invest money before it is taxed. This means you don't pay taxes on the money you invest right now, but you will pay taxes later when you withdraw the money, typically when you retire. For example, contributing $6,000 to a 401k this year would mean you get a tax deduction for that amount now when you go make your annual income taxes, but you will pay taxes on it, including the earnings and growth, when you withdraw it during retirement. Common examples include traditional 401ks and IRAs. On the other hand, tax-free growth accounts such as Roth IRAs and Roth 401ks work the opposite way. You pay taxes on the money you put in right now, which means no tax deduction up front. However, when you withdraw the money in the future, you won't pay any taxes on it, not even on the earnings or growth. Choosing between a taxable account and a tax advantage account depends on several personal factors like your financial goals, your current income, and whether you are investing for the short term or longer term. If you're saving for the longer term, like for retirement, using a tax advantage account such as a 401k or a Roth IRA makes sense because they provide significant tax benefits over the years. However, if you think you will need access to your money before retirement, a taxable account is generally better because it doesn't have age restrictions or penalties for early withdrawals, giving you more flexibility to use your money when you need it. Now that we have looked at the different types of investment accounts, let's dive into how taxes actually work on a taxable account. In a taxable account, you are required to pay taxes on the money you earn, including capital gains, dividends, and interest. Let's explore how each of these is taxed. When you invest in something like stocks, you hope the value of your investment will increase over time. If you sell your investment for more than you paid, that profit is called a capital gain. For example, if you bought a stock for $50 and sold it for $57, your profit of $7 is your capital gain, and it's what you will be taxed on. However, taxes are only applied in the year you sell the investment. If the stock has appreciated in value but you have not sold it, then you owe nothing to the IRS. How much tax you will pay on that $7 of capital gains? It depends on how long you have held that investment. There are two categories of capital gains: short-term and long-term. Suppose you bought a stock for $50 on March 15th and sold it for $57 on November 2nd of the same year. Since you have held the investment for less than a year, this falls into the short-term category, and the $7 profit will be taxed at the same rate as your regular income. So if you are in the 22% tax bracket for your regular income, your short-term capital gain will also be taxed at 22%. On the other hand, let's say you held the stock from company X for a year and a half before selling it. In this case, because you have held the investment for more than a year, it will be treated as a long-term capital gain. Long-term capital gains are taxed at a lower rate than short-term gains to encourage and reward long-term investment. The tax rate for long-term gains can be 0%, 15%, or 20%, depending on your total yearly income. And remember, capital gains taxes are only triggered if you sell an investment. If you hold an investment and it appreciates but it's not sold, no capital gains tax is due until you decide to sell it. Now let's move on to other important forms of investment income: dividends and interest. Dividends are payments you receive from a company for owning its stock, which is essentially a share of the company's profit distributed to shareholders. Interest income is what you earn from lending your money, such as when you invest in certificates of deposit, also known as CDs, or bonds. Generally, both dividends and interest are taxed as ordinary income, just like your wages or salary. However, there is a special treatment for dividends if you hold your investment for the long term. To qualify for this lower rates, you must hold the dividend-paying stock for at least 60 days within a specified period, which I won't go into detail right now. But know that as long as you are a long-term investor, you will most likely meet the requirements, and your dividends can be taxed at a reduced rate of 0%, 15%, or 20%, depending on your overall taxable income. Now that we understand how earnings from investments like dividends and interest rates are taxed, let's explore what happens if things don't go as planned and you lose money in the stock market. Suppose you bought a stock for $50, hoping its value would increase. However, instead of going up, the stock prices dropped to $42 and you decided to sell it. This results in an $8 loss. So what happens now with that loss? Does it have any impact on your taxes? Yes, it does. In the stock market, not every decision turns out profitable, but fortunately, the tax system allows you to use these losses to your advantage. When you sell an investment for less than what you paid, you incur what is known as capital loss. This $8 loss can actually help you at tax time. Capital losses can offset any capital gains you might have. For example, if you had a $10 gain from another investment, this $8 loss could be used to reduce that gain to just $2, bringing down the amount of taxes you owe on your gains. But what if you don't have any gains or your losses exceed that gains? In that case, you can use up to $3,000 to offset other income like wages from your job each year. What if these losses exceed $3,000? Let's say it was $3,500 instead. Well, you're still not out of luck. You can carry over the excess of, in this case, $500 to future years and use it to offset your income. You might be wondering, how am I supposed to keep track of all these transactions, gains, losses, dividends, and interest throughout the year? For a beginner, managing all this information can seem quite daunting, but here's the good news. You don't have to do it on your own. When you invest through a brokerage firm, they take responsibility of tracking all your investment activities. This includes every buy or sell transaction, any gains or losses, and all dividends and interest you earn. They complete this data for the entire calendar year from January 1st to December 31st. By February 15th of the following year, your brokerage firm will provide you with a Form 1099. And this important document summarizes how much money you made or lost in the stock market, and it includes all the details, which simplifies the process of reporting this information on your tax return. You simply grab this document, give it to your accountant, and it will be listed when you guys make your income tax. That wraps up our discussion on how taxes impact your investment. If you found this video helpful, please like and subscribe. Thanks for watching. Catch you next time. Bye.